UBS's senior economic advisor, George Magnus, here in the studio with me. George, it's good to see you.
Hi.
So, are we going to see a breakthrough when it comes to a comprehensive agreement between Angela Merkel and Nicolas Sarkozy on Sunday?
I don't think so. I mean, obviously expectations are running extremely high. And I think there are certain things that they definitely have to make some proposals and announcements about. But this is not going to be a plan to save the euro. In fact, they're not even really going to talk about the issues which eventually could save the euro if they so chose.
And do you think that that is behind some of the comments we've been hearing from Germany, essentially downplaying expectations, saying that if you're looking for a solution, forget it?
I'd like to think that this was a kind of a calm down dear kind of statement, which was, we're going to do something, it's not the be all and end all, but the rest will come later. But I'm not even sure about the rest coming later. So this is really going to be about finance. We know this. It's going to be about the recapitalization of banks. It's going to be about some proposals which may still be quite vague about augmenting the European Financial Stability Facility and about the haircut for Greece on the private sector involvement.
Yeah.
It's financial engineering. It's necessary, but it's not the answer.
And how contentious an issue is that, the increase of private sector involvement? We know, I mean, there seems to be a consensus out there that, look, it's not going to be 21%. We're actually looking at something closer to 50%. And of course, then you have Germany on the one hand pushing for more of a write-down. You've got France and the ECB saying, hold on, not so fast, it needs to be voluntary.
I think there'll be some sort of compromise, and in most things, Germany actually is going to get its way. I mean, it obviously it does pander to other people's, sensitivities, but actually, these are the days now when effectively what Germany wants actually will come to pass. It's the biggest creditor; it holds all the cards. But I think one has to be a bit careful about this, obviously, because the banks are railing against the prospect of having a bigger write-down, and they'll probably say that this is a Greek-only phenomenon, and actually we can't, we're not going to deal with other countries like this. Well, I wonder how that will go down in Lisbon and Dublin, for example.
And is anyone going to believe them when they say that?
That it's only Greece?
Yes. How difficult is it going to be? The idea of being able to ring-fence the situation, control it in that way.
I think it is. I think it's a leading edge. I mean, this is clear, unequivocal debt relief for Greece. It's necessary. It's your previous package about the incredible social political situation in Greece. This is really, really dangerous. And I think that there needs to be some kind of debt relief program, actually, not just for Greece, but obviously for other debtor countries too.
And is that on the table? Is that even being looked at right now, or is all the focus going to be on Greece, and then, well, by the time they get on top of that problem, there will be all these other issues escalating in potentially larger Eurozone countries?
Yeah, it is the focus, and it is very, very Greek-specific for obvious reasons. But that's what I kind of mean, that that all of this financial engineering is good for purpose for the immediate future, but actually it doesn't solve the problem of the euro, because the whole Eurozone debtor nations need debt relief in the context of a kind of a growth agenda which will help them get out of debt. And all you do is trying to solve this from crisis to crisis by looking at the financing of the debtor countries without figuring out how they're going to basically adjust to the to the aftermath of the debt crisis. Then they'll never get actually sorted out.
Is that what these protests are essentially about? And we have seen, and it's not just in Greece, is it? I mean, we've seen the protests, well, here in the UK, we've seen it on Wall Street, we've seen some very, some incredible pictures coming to us out of Rome and now in Greece. Is this all a painful process of adjustment to a new reality?
It is. Well, of course, it's vehement distaste or disagreement with what people perceive to be harsh conditions or unfairness or social justice. I mean, these things obviously vary from country to country, but from the kind of bird's eye view, as it were, I think we also have to put this in the context of the fact that you cannot have a solution to the euro problem or the euro crisis, or indeed to for the predicament in Western countries by effectively forcing austerity or hailing austerity as the only means of solution. This is what I've called deficit attention disorder. It's just total obsession with the wrong things. You have to have an agenda for growth and to give people some reason to think that, there is some light at the end of the tunnel.
So what did you make of some of the comments we were hearing there from Mr. Clausen? He's saying that current market conditions are they're just as extreme as they were during the Lehman's collapse. So how do we get the confidence back?
Yeah, this is a bit of kind of motherhood and apple pie and flying pigs, I think. I think it goes without saying. I don't mean that disrespectfully. I mean, I'm sure the CEO of Nordea is right. We clearly, confidence is desperately needed, and we need to see the things that would give rise to that. But you can't just make it happen just by kind of saying it's got to happen. And so clearly, this coming set of announcements and proposals from the French and the Germans and the European leaders, obviously very, very important. But as we were talking about before, there's so much more to it. I think the immediate thing from the point of view of European banks that I took away from his statement was cost cutting and asset shrinkage. I mean, he didn't say it in so many terms, but shutting down of branches or restructuring was the kind of words that he used. And this is obviously something which European bankers have threatened the European politicians with, like, if you make us raise more capital, we'll just basically accelerate loan shrinkage and asset shrinkage and restructuring. And there's almost a kind of a veiled threat there, which is that, and you don't want that, do you? Because that's just going to exacerbate the weakness in Europe's economy. Well, this is shaping up to be a bit of a kind of a battle, really, between the banking elite and the political elite, actually, as to which one will win out. Clearly, the politicians are responding to sort of a lot of public pressure to make sure that the banks are stronger.
So what do you expect to see with regards to the recapitalization of the banks?
Well, I'm pretty sure that it'll be shocking if they do not have concrete proposals to conduct stress tests, on the fourth time, by the way, to proper stress tests which will lead to a material recapitalization of banks. But I think it is dangerous for the leadership of Europe to believe that they might be able to drown the whole issue of the euro in bank recapitalization. It's one important issue, but only in context of strengthening the entire fabric of sovereign solvency and economic growth. If they just do bank recapitalization and think that's it, I don't think it's going to be successful.
But I suppose it has to be the first thing that they tackle on the road to a managed, orderly default. We were just taking a look at some of the share prices of France's biggest banks today, and much of that is being driven by concern about their exposure to sovereign debt, isn't it?
Well, that's why you can't do bank recapitalization in isolation. It's got to be part, when they talk about big bazookas, much more important than whether it's 1 trillion or 2 trillion or 10 trillion euros, which is a bit kind of nonsensical. Much more important for the big bazooka is that it should hit about a half a dozen spots simultaneously. So bank recapitalization, restructuring of broader kind of debt arrangements in Europe, debt relief, sovereign solvency, all of these things need very, very concrete proposals.
How important is expansion or magnifying of the EFSF, the Eurozone Bailout Fund, to at least a couple of $1 trillion, an important step on the road to addressing sovereign solvency, as you say?
Well, to be honest, if they put money on the table and said, right, we'll show you the money, and this is how good the EFSF is, then I think the market's acceptance of that and the credibility of that would be much greater than some of the proposals which look like they're being talked about, including this insurance of first loss proposal. It may help.
Is that a credible proposal in your view? The idea that it would insure 20% of a loss on European sovereign bonds?
It might tempt some creditor banks and creditors to basically say, well, this is a better deal than the one we've got at the moment. But actually, if you think the other 80% is going to cause you a loss, why would you be tempted to go for this in the first place? So, it's a piece of financial engineering which might work in the context of other supportive policies. But I just feel that the focus is far too much now on the financing arrangements to the neglect of all else.
Just a quick one, a very quick response from you. Magnifying of the EFSF, bank recapitalization, we're ultimately talking, however you do it, we're ultimately talking about a transfer of debt risk to core countries, right? Either way, we're moving towards France and Germany, core countries, taking on more liabilities from the weaker countries. What does that mean for their position going forward?
Well, and this is the other kind of flaw in the plan, which is that you're just piling up sovereign liabilities, whether they're contingent or actual, which is the core of the problem in the first place. So they're not really kind of breaking the circle of the vicious circle.
Well, thank you so much, George Magnus, Senior Economic Advisor to UBS.